Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. So glad to have you tuning into this episode, number 401. The title is To Insure or Not to Insure, Decoding the Need for Long-Term Care Insurance. Before we get started with today's show, I always like to start the day right by renewing our mind, and I've got a verse here for us from Proverbs 4:23. Above all else, guard your heart, for everything you do flows from it. And then, of course, I like to put a smile on your face, give you a joke you can share with the grandkids. Why did the tomato turn red? Because it saw the salad dressing. One of the major things that can derail a good retirement plan is experiencing a healthcare event that doesn't kill you, but requires you to need care for an extended period of time. The healthcare events that could cause you to need long-term care range from frailty and aging, recovering from an accident, having a stroke, getting cancer or Parkinson's disease, dementia, and of course the one that most of us fear is Alzheimer's. Several years ago, many states created the Long-Term Care Partnership Program to encourage individuals to purchase long-term care and, in doing so, protect some of the assets from a Medicaid spend down. More recently, Washington State passed the Washington CARES Act, which is a payroll tax to help cover the costs incurred by the state for long-term care and, in exchange, have a very limited long-term care benefit. Initially, we were enticed to buy long-term care insurance for asset protection and the possible tax benefits. Now we are being forced by way of taxes to cover the cost of long-term care. It sure seems to me that you're going to end up paying for long-term care insurance one way or another. And as I understand it, many more states are considering this type of payroll tax following in the footsteps of Washington State. So if this is something that's of concern to you, you're definitely going to want to tune in. Here are some of the topics I cover in today's podcast episode. When do most people buy long-term care insurance? The 4 most common ways people care for those who experience a long-term care event. The average time that people need care. How much you can expect to pay for long-term care insurance premiums. Some companies are now considering family history in their underwriting process. This wasn't the case years ago. And then hybrid and asset-based insurance and who they may be good for. One way to determine if you'll need insurance or if you can self-insure is to create a retirement cash flow plan in the retirement budget calculator. Then create a new model and add the expense of a care facility and have that expense start in a future year. So maybe when you're 80 or 85 years old, you could model to see if you've saved enough to cover the cost of long-term care way out into the future. The calculator will help you see the impact and understand how a long-term healthcare event can impact your financial well-being and help you to know if you should purchase insurance or self-insure against this risk. As always, I'm going to have articles, links, and resources in the show notes if you want to explore the topic in greater detail. And if you enjoyed this episode and you're studying this topic of long-term care, you might also want to listen to the episode number 31, which is all about continuing care retirement communities. Listen to episode number 81, which is about reverse mortgages and how they can be used to help pay for long-term care. Or listen to episode 218, Long-Term Care Planning with Elder Law Richard Tizano, where we discuss some of the nuances with Medicaid planning. Today, it's my good fortune to bring David Clemons onto the podcast to discuss long-term care insurance. I've known David Clemons for nearly 20 years, and during that time, his specialty has been helping people come up with and plan for how they're going to handle a long-term care event. Here's a little bit of his bio. David Clemons has been specializing in long-term care insurance since 2002. He's known for his expertise and straightforward approach to helping people understand practical and affordable solutions for their long-term care needs. He will help you assess your long-term care requirements and, if appropriate, choose an insurance program to help you protect your financial independence and maintain your financial security. By representing multiple insurance companies, David can help you determine which company is going to best meet your needs. David has been an endorsed local provider in ELP for the Dave Ramsey organization since 2009, and he teaches the Financial Peace University class. A 1979 graduate of the University of Idaho, David has lived in Kirkland, Washington since 1993 and is married to his wife, Barry, and has two daughters, Andrea and Bryn, and has 4 grandchildren. He spends his free time working out in the gym, biking, or on the golf course. And now his new passion is pickleball. Without any further ado, here's my interview with David Clemons. All right, so it's my good fortune to bring David Clemons onto the program. David, welcome to Sound Retirement Radio.
Thanks so much, Jason. Appreciate being on today.
We have known each other now. It's got to be at least 20 years. And I'm so grateful that you're willing to take the time to come on to the show to educate our listeners about this really important topic of long-term care insurance. And maybe even backing up a little bit and just understanding what long-term care is. So if we could start the conversation there, help our listeners understand what long-term care is.
So great. So long-term care, by definition, it's a medical or cognitive impairment situation that has the expectation, and that's kind of a key word when it comes to the insurance, an expectation that that disability or chronic condition is going to last 90 days or longer. There's 2 types of definitions. There's the cognitive impairment like Alzheimer's or dementia, Parkinson's, where somebody's mental capabilities, diminish to the point that for their own safety and well-being, they need to be watched and supervised. That's about 65% of all long-term care insurance claims is the cognitive stuff. Trigger is what's called activities of daily living. Those are physical or, movement functions that we do, like bathe ourselves, dress ourselves, go to the bathroom by ourselves. So if you get to a point where you can't do 2 of those 6 ADLs, as we call them, and that broken hip's going to take you out for 90 days or longer, well, then the long-term care insurance will now provide tax-free money to pay for the caregiving that you will need, whether that's in your home, a nursing home, assisted living, or whatever kind of community you would choose to move to, because the insurance is comprehensive in that it lets you be wherever you want to be. And even most policies have an international benefit. You could be in Canada and be cared for if you want.
Most people don't want to think about long-term care. Most people don't want to think that could ever happen to them. Do most people reach out to you, David, to look at long-term care insurance as a result of experiencing a friend or a family member going through a long-term care event? Or, how do you have this conversation just dealing with this idea that this is something that could happen to us in the future, and that's why you consider insurance?
There's 2 major places that I get referrals or prospects to talk to. You hit the first one. It's a family member, the son or the daughter, who's 50 years old and mom's 70 and's had the stroke. So it's usually a family experience where the daughter or a family member has been taking care of their parent for a while, and it's just become a big deal. Another large group of referrals comes from people like yourself, financial advisors, state attorneys, people that are recommending that this is a solution to help protect. So it comes from either direction, but mostly it comes from a family member that's experienced it. Because when you call up a community or a place to get services for long-term care, one of the very first questions the company asks you is, does this person have long-term care insurance? And if you do, you kind of get some preferential treatment and placement. You get placed higher and quicker on the waiting list because you have insurance in some cases.
Just a moment ago, before I hit the record button, you were sharing some statistics with me about the average age of people that end up needing long-term care. What was that number again?
Well, the average age of somebody buying a long-term care policy from me in the last 20 years has been 52 years old.
Oh, interesting.
But most importantly, when to buy long-term care insurance really comes down to 2 things. Has nothing to do with age necessarily, but more importantly, you have to be really pretty darn healthy now in order to qualify for this insurance. My placement rate the last 3 years has been about 45% of the people that apply for coverage get declined. And these are people that, from 40 to 70 that are applying for coverage. So you have to be very healthy. The second thing is you have to be able to afford the premiums. And sometimes somebody in their 40s just has too many other things going on, saving for college for the kids or paying off the house or whatever. But so, when people get the kids out of the house, now there's some freed up money that, they put into the affordability of the insurance, or a term life insurance policy ends at 60. And that's when they take those funds and do long-term care.
Okay.
But health is most important. And the younger you buy a policy, overall, I can prove it 100 different ways. The younger you buy a policy, the less you'll pay for it over your whole lifetime. And if you don't need to use it, well, that's a good thing.
Yeah. So tell me what that looks like. Like, what's the break even when making that decision about the cost of long-term care? You say the younger you buy it. My wife and I were 38 years old when we bought our policy, but why does it pencil out to buy it younger if you can afford it?
So great question, because there's three different rates with most insurance companies, good, better, best, if I could just use that. I'm assuming you and your wife got the best preferred rate, which is, the younger you are, the healthier you're probably going to be. And that's a 15% discount from preferred rate to standard rate. If you're just taking a blood pressure medication or a cholesterol pill, you're not going to get preferred rate. So, if you buy a policy 5 years before you're taking a pill, well, you've just saved a bunch of money. About every 5 years, once you get over 50, every 5 years, the premium's going to double. Just technically, I can say that just matter of factly. So, between 55 and 60, what you would have paid at 55 is going to be twice as much, and you still have to hope you're really, really healthy. So we got the younger you are, the less the initial cost is, and then there's preferred health discounts. And of course, you can say, I'm going to wait until I'm 60, and all of a sudden you've had diabetes and a stroke, and you're not buying long-term care insurance. You waited too long.
It's not an option anymore.
Yeah.
When you talked about premium increases, you're talking about the difference in the premium based on the age that you are when you buy the policy, not necessarily the premium increases for somebody that already owns a policy. And I know that's an issue. I'm getting ahead of us where I want to go with this conversation, because I want to get back to the basics here. So let me take us back to somebody needs long-term care, and what are the options they have for handling that event? They have an event that either they need 2 of the 6 activities of daily living, or they come into this, they have this cognitive impairment.
So that's really the best question to talk about when it comes to long-term care, because there's really only 4 ways that a person gets cared for or gets the financing handled for a long-term care event. The first way is family members are obligated, they want to, they get to, they're expected to take care of mom. And, I've got over 100 clients on claim right now, and the family dynamics that I see happen when, a daughter has to take off of work 4 days a week to help her mom, and then the brother's not helping, and, but family members are sometimes, expected to be caregivers. Of course, spouses are. But there's 40 million unpaid family member caregivers in our country. So it's a big deal. That's how most people get it done, is they take care of each other. The second way you take care of long-term care, you just have to write a check. And today in the Seattle area, the home care agencies are charging $50 an hour, 4-hour minimum. And I see bills from $5,000 to $15,000 a month for my clients. So if somebody's got a $5,000 or $10,000 bill, they just have to liquidate wealth. And it's okay if you're wealthy. I'm going to say if you have over $2 or $3 million, you've got the wealth somewhere in your portfolio to be able to liquidate and just pay the bill. Well, if you're just paying, you can pay your kid to take care of you if you're using your own money. But the insurance companies now, they require you to use a licensed home care agency for the home care, not the older policies that Jason, you and I have. We can hire anybody except a relative to take care of us. So we got our families and our own money. Long-term care insurance is the third way. And all long-term care insurance really does, it provides tax-free revenue funds to pay for care. So you don't have to wipe out the nest egg, and the kids maybe do inherit more. But more importantly, the insurance money is a permission slip, so the kids don't have to do it all. Certainly your kids can come over and mow the lawn and do the dishes, but to have them be your physical caregiver and bathe you and do those kinds of things, for some families is stressful. The fourth way we take care of people is the ones that run out of money, and that's Medicaid. That's welfare. And you have to be pretty broke. For a single person, you have to be down to $2,000 in countable assets before Medicaid takes over. And now your choices and where you get cared for and by who are really up to the government to decide.
So long-term care insurance, you mentioned that it will cover you in all these different places: home care, assisted living, nursing home care, but you have to qualify for it first. And one of the things I've found walking life with people that are retired, David, is sometimes people have long-term care insurance and they're afraid to use it. Would you maybe take a minute and talk about that?
I just had a wonderful conversation with a memory care community director, because people don't want to open their claims because they think the limited bucket of money, because that's what you have. Most policies have a finite amount of benefits that they don't want to use them up. My own parents were in that same boat. My dad took forever to file a claim. Not only does the premium stop when the claim is open, which is, sometimes the premiums are expensive, so you don't pay the premium when you're on claim. But my parents, I guess I'll use my parents as an example, they just didn't want strangers in their homes, for the home care. So my dad did it. He was doing all the caregiving as much as possible. So, people dynamics, they just don't want strangers in their homes, and then they have this bucket of money. They're just afraid to use it because they might use it up. The average claim for somebody that needs long-term care is 3 to 4 years now.
Okay.
So, if you file the claim for the first year, you probably still got a whole bunch of time left to use your money. But if you die in 9 months, well, you should have used the insurance earlier.
Yeah. If you have the insurance and you need it, use it. It's not something you're trying to save and pass on to the kids, but it would be nice to save the money. But I tell you, I have these conversations with people. It's like they need to activate the policy, but for whatever reason, there's a reluctance there. So you said the average claim is 3 to 4 years. That's what the insurance companies are experiencing from a claim standpoint. Because I remember they used to say that the statistic used to be 2.5 years was the average length of time that people needed care, but now it's up to 3 to 4 years. Is that just medicine, science, technology getting better? And
it's mostly because the cognitive impairment, the Alzheimer's and dementia claims are much longer, 5, 6, 7 years. The real statistical numbers are, of all claims, the average length of a claim is 2.8 years. So I'm rounding that to 3. But if a claim lasts longer than 1 year, then those claims are averaging at 4. So, that means the 10-year, the 8-year, the 7-year is averaging in with the 1 and the 2-year to make the 4. So if you've got a cognitive impairment, your body might be in great shape. Your mind just might be a little worn out, and you might live for years and years with dementia.
You said that the average age that somebody's looking at long-term care insurance is 52, or at least from the people you've helped over the years. Is that the right time, you say, to buy a policy in your early 50s? I know there's people like Dave Ramsey and Susie Orman. You hear them talking about age 60 is the time to buy long-term care insurance, but what do you say?
Well, I bought my policy at 44, right after I learned what long-term care insurance was about. It was right after my parents bought their policy, because it was back to the Christopher Reeve story where Superman had fallen off his horse and broke his neck. He needed care for 10 years. But the right time is when and again, most people under 50 or 60 have never even heard about it unless their parents have had an issue. So it's when people get informed about it, then feel that the risk is serious enough to worry about, and then they get educated and buy it when they can afford it and when they're healthy enough. There really isn't. I get disappointed, I guess I'll say, when somebody over 65, contacts me about insurance. It's because it's probably unlikely they're going to get approved, or it's just going to be too expensive for that person's retired budget.
Is there a point where you find it really does become unaffordable, an age where it becomes unaffordable?
Well, it's all based on somebody's lifestyle and portfolio. If somebody's got $5 million, they can afford anything. They can afford an $8,000 a year premium to protect. They can also self-insure. The one thing that I found is that somebody that's self-insuring, for whatever reason, liquidating their money can be problematic. Selling mom's house might not happen in 5 minutes like it did 2 or 3 years ago. It might take years and years to sell the house at a big discount because the market's soft. Somebody's stock and mutual fund portfolio, you're going to pay taxes on most of that money or capital gains. Selling mom's car, I know a lot of times the car gets sold. That $30,000 car only gets sold for 20 because you got to sell it fast. So there's opportunity cost and just closing out asset costs that sometimes can be more expensive out of pocket money than just having had insurance to protect it. I always just say that, here's a risk that we have. All of us have a 7 out of 10 chance. 7 out of 10 of us are going to need long-term care. And if you have a probability risk of that high and you can buy insurance for that, I mean, why would you not if you could?
Well, it brings up some good questions, such as with long-term care insurance companies maybe not having underwritten these policies accurately to start, because we've seen companies leave the long-term care space. We've seen a lot of premium increases. As you look out into the long-term care marketplace and you see people living longer and dementia becoming more prevalent and medicine, science, technology keeping people alive longer, do you think long-term care insurance is going to continue to persist, continue to exist into the future?
I'm going to almost disagree with it. That's the wave of the future is more and more long-term care insurance because 22 years ago when I got in this business, there was 113 companies selling long-term care insurance. There really is only about 13 now.
Wow.
And so the reason for that is because the companies just aren't making any money. And I'll just compare it to, let's say in Florida where homeowners insurance, because a hurricane wipes out the house every 4 years, homeowners insurance is really expensive if you can even get it in Florida. Well, here's, again, a risk that 7 out of 10 people are going to need long-term care. And interest rates have been the big bugaboo with insurance companies for the last 10 years. Interest rates, the 10-year bond's been under 2%. And insurance companies, insurance policies grow at 3 or 5%. So the math just wasn't working, that the companies just weren't making any money. So that's why the John Hancocks and the Genworths and a lot of the companies just quit selling because they just weren't making any money. And then of course, underwriting, they sold anybody that could fog up a mirror, as we used to say back in the old days. But now it takes about 45 to 60 days to get approved for a policy. It's crazy.
45 to 60 days just to get through under. But this is my point. I mean, the fact that there were 113 companies, now there's only 13 companies. Are we going to get to a place where there's not going to be anybody that wants to take this risk on the insurance side? Or insurance companies just going to say, hey, we're not going to do this anymore?
That's altogether possible.
The nice thing, though, these policies, they are guaranteed renewable. So if you have a policy and you keep paying the premium, the insurance company can't get out of the contract, correct?
That's true. And people say, well, what happens if the company goes out of business? Well, there's a state, it's called the state guarantee funds. It's kind of like the FDIC as it relates to bank accounts, but there's insurance on your insurance in case that specific insurance company goes out of business. The state that you bought the policy in is on the hook to cover you.
You mentioned a moment ago $2 to $3 million. If somebody has $2 to $3 million, they may not need insurance. Is that where you is that the point where you feel that people can self-insure for long-term care, as if they have $2 to $3 million of liquid investable assets?
That's my opinion, only because I know that they've got enough money to handle $100,000 a year bill. Somewhere in that $3 million is money that can be spent on care. Also, I mean, somebody that's got $3 million can afford an insurance policy for $3,000 to $5,000 a year. So it's a win-win for somebody with wealth. I mean, they have their choices. So it's just a matter of, does somebody really, are they worried about long-term care, and do I want to protect my money for the kids? Because some of the illustrations now, the company's illustrations will show what's called a break-even point of the amount of money you put into the premiums based on how many days of care it takes to get the money back. And in most cases, it's less than 6 months. So you pay for this insurance for 25 years and then you have a stroke. Well, you get all the money back you put into it in about 6 months, approximately.
6 months you break even, and then anything beyond that, you're into the insurance company's pockets.
Yeah. And so if you have the average claim is 3 years. So if you have an average claim, you made the right decision to buy insurance. Now, the other thing that I've seen happen in my 20 plus years in this business is a lot of people will self-insure. Well, when it comes time to actually, come up with the money to pay for it, not only do the kids not want you to, they don't want you to spend $50 an hour to pay for care, but you don't want to spend the money either. You got your $3 million because you were cheap.
Yeah.
You saved, and now you don't want to spend 10 grand a month on something that you never wanted to spend it on. So then they actually, in some cases, many cases, the spouse is forced to be a caregiver, or the kids are forced to be caregivers. And now what you have wanted to avoid, you don't avoid because nobody wants to have you spend your money on it.
You mentioned that this care or this insurance is getting harder and harder to qualify for. Can you give our listeners, because I know that there's people out there that say, boy, I'd really like to get insurance, but maybe they waited too long. Maybe they are 65, or what are some of the concerns around underwriting? Like, what are some issues where people would think, oh, I'm healthy, but then you find out they go through the underwriting process and they just can't get insurance? Is there something that you see coming up time and time again that kind of knocks people out of being able to qualify for coverage?
Yeah, that's a great question too. So some of the companies now, Mutual of Omaha, who I think is the best product right now, if somebody has both parents that have had dementia or Alzheimer's, they can't buy from Mutual of Omaha.
Oh, really?
So,
They're looking at your parents' conditions now, and wow, that's new.
family history's involved now.
Wow.
Not all companies, do family history, but Mutual of Omaha, again, who I think has the best policy. If you've had two parents or a parent and a sibling with dementia, you can't buy from them. But what keeps a lot of people from either applying or getting declined because they don't tell me everything on the application is you have to have had a full physical with blood labs within the last 24 months, or you can't even apply. You can't be in any physical therapy. And, somebody says, I'm really in really good health, but they had a knee replacement 3 months ago and they're still in PT. Well, you have to be at least 30 to 90 days, depends on the issue, 30 to 90 days free of physical therapy for any kind of a surgery. You can't have any pending surgery, from a bunion surgery to cataracts. You have to have the surgery first and then survive it and recover from it before you can apply. Can't have had COVID. And if you went to the hospital on COVID, you've got a year wait.
Is that
if
right?
you just got COVID, if you currently have COVID, you can't apply. And I've got 6 people waiting to, have their negative test to be able to apply. But, they had COVID at the day I talked to them a couple of weeks ago.
Wow.
But any new diagnosis like high blood pressure, diabetes, you have to have a 6-month wait for that medication to take effect and do its thing.
Oh.
So if you applied for insurance, or if you tell me I just got diagnosed with diabetes, well, I can't talk to you for 6 months.
Okay. So diabetes doesn't necessarily mean you're uninsurable. It just means that you're going to have to wait and see how things come together before anybody's even going to consider you.
And there's, height and weight. There's, it's kind of like a baseball game. You can have one issue. That's okay. Strike 1. Strike 2 is another issue. And strike 3, you're out. So diabetes, weigh 300 pounds and be a smoker, you're not getting insurance.
Yeah. Yeah. Cost. How much should somebody be budgeting for long-term care insurance? Can you give us a range of an idea of how much somebody should prepare to pay in premiums for long-term care insurance?
So right off the top of my head, if you're a couple in your 40s, you're looking at about $3,000 a year, $250 a month. If you're a couple in your 50s, you're looking at, $4,000 to $5,000 a month. I'm sorry, a year. It's not a month. And then if you're in your 60s, you're probably looking at $500 a month in premiums.
Okay.
So there's so many different variables in a policy that, sometimes you don't need the Cadillac product. If you got the $3 million, you don't need the Cadillac product because you can self-insure, or another term, co-insure. You'll have the insurance help a little, and you'll have your own bucket of money help a lot, and the kids will help too. So, really it's a 3-way solution, and a person's plan needs to, incorporate how much family, spouse, kid help, grandkid help you're going to get with how much money you want to spend of your own, and then how much does the insurance want to help.
Yeah, and that's something you were saying too, is that you just really believe strongly in people having a plan for how they're going to handle something like this when it does come up, so that they're not in crisis management mode. So regardless of whether or not insurance is part of that plan, you just want people to feel good that they know what direction they're heading.
Right. And less than 20% of our adult population has this insurance. So it is one of those things. And I think you mentioned at the beginning that, this is a subject that nobody wants to talk about. But it's inevitable that we die, and 7 out of 10 of us are going to die slow enough that we're going to need assistance. It's kind of like the same statistics. 70% of our population doesn't have a proper will or an updated will or even power of attorney documents. So that when they, are in a bad way, their paperwork, for just their life and their wills aren't in place because nobody wants to talk about their wills. So a will and a long-term care plan kind of go hand in hand, because your will tell your family how you want to be taken care of if you become incapacitated.
Yeah. There's a lot of different types of long-term care solutions out there today. We've seen a lot of innovation from insurance companies, and you have the traditional type of long-term care policy. You have these hybrid policies that are life insurance based. You have these annuity policies that can help provide some coverage for long-term care. Talk to us about the different types of insurance available for people today and your thoughts about those different options.
So in my almost 22 years in the business, I'm a big fan. I personally own a traditional long-term care policy. I think, based on what I know, just what you put into it in premiums and what you get out of it in features and benefits, there's more bells and whistles of riders and things you can do with a traditional policy, like shared care and survivorship riders and things that you can't do with the others. The hybrids, which became popular about 5 or 6 years ago, were just another way that the insurance industry tried to come up with another mousetrap to sell, because traditional insurance was going through the rate increase dilemmas, because all the companies that have been around for 40 years had to start raising rates. But the hybrids it's a permanent life insurance policy. So you're buying a whole life, permanent life insurance policy. And if you die, you get the death benefit. The hybrid part of that is it also includes a rider for long-term care, that if you need long-term care, well, you spend the death benefit of the long-term care, of the life insurance, paying for the long-term care. So the sales pitch is that you win versus the insurance company, because either you're going to get the death benefit of the life insurance, or you're going to get long-term care, or in some cases a combination of both, but you're going to get that benefit paid to you. But I just think they're real expensive. It takes, for a 55-year-old person, takes about $100,000 to buy that kind of a policy. And again, if somebody's got 3 million, they can do that without even adjusting their world. But most people that are, have under, $500,000 in wealth, they can't buy those. They think they want to because it sounds good. It's a win-win on, you'll always get to use it. But life insurance, if somebody at 55 already has life insurance dialed in, or they're only going to need life insurance for a few more years because they bought term to make it till 60, well, why would you buy additional life insurance? And then the annuities, the annuities are a wonderful option if somebody is not healthy, because those aren't health underwritten.
Okay.
And what you get with those is about a 3-to-1 leverage. You give them $100,000, you get $300,000 in long-term care. And if the person dies without needing long-term care, the $100,000 annuity, which has been growing at a very low interest rate, there's an asset that gets inherited.
Okay. So it's a way to leverage up your own money. It's a way to self-insure in a sense, but you're not really self-insuring. You're handing over some of the risk to the insurance company, and in exchange, you're having to give up a big chunk of money all at once. Do you find that people that are higher net worth tend to buy insurance, or do they choose to self-insure? What's your experience?
I think there's kind of I'm going to call it a sweet spot. People between $500,000 in net worth, and I'm talking about a couple, $500,000 to 3 million will buy insurance. The guy with 25 million or 10 million, they won't. But if somebody doesn't have, significant wealth, and I'm saying, at least a quarter of a million, you almost can't afford it, because if you're 65 and only have $200,000 in your world, you need to be putting more money in your own bucket to get through life.
It's interesting though, David, we tend to meet people that are doing pretty well. And I've met people that have 10, 20, $30 million. And many of them do have these asset-based hybrid long-term care policies, these life insurance policies that have a long-term care rider on them. And so I've actually been surprised when I see people that have that much of liquid net worth and still have insurance. So my experience has been that people the higher net worth people seem to understand the value of insurance.
Well, I agree with you because I'm going to give a shout out to people that did things well in life and invested or saved or inherited money and have wealth, is they make good financial decisions. Either they're getting advice from people like you to do it, or they just know that here's this risk that I have a 70% chance of needing long-term care, and I can buy insurance for that, and I can afford to buy insurance for that. Why would I not?
Mm-hmm.
So logically, I think everybody should at least consider it, just because it's devastating on a family dynamics level, and your checkbook gets hit pretty hard.
Yeah. For Becky and I, we just saw, we experienced this with family. We saw her family go through long-term care events, and we were like, boy, we don't want to put our kids in this type of situation. That was the big motivator for us. We pay into Medicare all of our lives, and then there's also Medicaid. Will you talk to us about what role Medicare and Medicaid play in helping to pay for the cost of long-term care?
Great. Well, Medicare is one of the most confusing thing for most people until they hit 65, which I did 2 years ago and got to learn all about. Well, I already knew it, but just buying the Medicare insurance. But Medicare, I'll just make a flat statement, does not cover long-term care, Medicare. But Medicare does provide a rehab benefit. This is out of the Part A piece of the medical insurance of Medicare. Part A, it's the hospitalization benefit. If you spend 3 nights in the hospital as an inpatient, and then you get discharged from the hospital after 3 nights in the hospital, and you need rehab, Medicare will pay up to 100 days of that. If you don't spend 3 nights in the hospital, you don't get much at all. If you might get a little bit of home PT from home health that'll come in and do some PT for you. So in a sense, Medicare doesn't help. It helps with that first initial window in some cases, pretty rare though. And Medicaid, and that's again 2 M words. I wish they weren't both M words, but Medicaid is welfare. And once you're on welfare, it means you're broke. And they take, not only does Medicaid take your Social Security check or chunks of it to pay for your care, because now you're being placed in some sort of a community, a nursing home, adult family home that'll accept Medicaid. In the Seattle area, less than 10% of the beds of any of these retirement communities, nursing homes, adult family homes, less than 10% of the beds will take Medicaid. Adult family homes, in some cases, if you can self-pay or self-fund for the first couple, 2 or 3 years, then if you run out of money, they'll let you stay on Medicaid in that place. But Medicaid is not where you'd want to be. And there's plenty of people that get advice to, it's called the 5-year look back, where your wealth goes, and people will give their money away or hide it or whatever so they can qualify for Medicaid. Well, that's not a good solution anymore. 10 or 20 years ago, it wasn't a bad thing because every assisted living and nursing home took Medicaid.
Oh,
now,
I see.
Hardly any of them do.
So playing this game where you try to give all of your assets away before 5 years, before the look back period kicks in, that doesn't really work that great anymore because you still have to find a facility that's going to accept Medicaid. Now, I've been down this path recently with some family members, and I'll tell you, one of the things I found on this Medicare benefit, this rehab benefit where you have to spend 3 nights in the hospital, I knew that was the case, so I really had to advocate for this family to make sure they spent those 3 nights because we knew that we wanted that 100 days of care. What I found out, David, was that those 100 days of potential care through Medicaid or through Medicare are dependent on this idea that you're showing signs of progress, that you're getting better. Yeah. And what I found when we were going through this is that at about day 12, the nursing homes are audited very hard on this criteria. And so most people don't get beyond, even though there's potentially 100 days available, if you're not showing signs of progress at about day 12 is the most benefit you're going to get out of that 100 days of Medicare. So just because you hear that Medicare has 100 days of potential coverage available if you meet their criteria, no, that's only if you're showing signs of improvement. And when you have dementia or Alzheimer's, usually you're not showing many signs of improvement, unfortunately.
Yeah, the nursing staffs in the rehab centers chart you every day on your progress of rehab because you're rehabbing. I mean, you had a knee replacement or you had a stroke and you need some PT to get your arm to work again. But after that 12 days, they know you're either chronically this way forever or you're getting better. So it's
We also had the experience of paying down. So in this particular instance, there was no insurance. So it was just whatever resources you have, we have to use those resources to pay for the long-term care. And that meant we had to sell the house. And, you know, those long-term care expenses start to pile up. I mean, you're looking at $5,000 or $6,000 a month to start when you go into an assisted living facility. But as the level of care increases, the level of cost increases. One of the things that we were considering was Medicaid. We said, okay, well, once we run out of all of the money, we know Medicaid's going to have to kick in. So we found a facility that said, hey, look, if you spend your money with our facility, we won't kick you out if you go onto Medicaid. And I thought, oh, that's good. So we won't have to find a new place. You know, what I didn't realize though, and having that conversation, David, was that's assuming that they can provide the level of care that's needed. Unfortunately, right at the time the money ran out, they also made the determination that the level of care that was required was beyond what they could provide. And so we were not only out of money at that point, but then we had to go find a Medicaid facility, which, as you pointed out, is no easy task. And so there's a lot of things that people think, you know, there's a lot of ways people think this is going to work when they get to that point. The other thing to remember is unless you have somebody in your life that's really helping you navigate this, it is a complex maze, and it is not an easy thing to navigate your way through. We did have some amazing people at the hospital here locally that were able to help facilitate finding a care, because fortunately, we went from a long-term care facility to the hospital, and then the hospital was kind of on the hook to find a facility that would accept Medicaid at this, the last 30 days or so is really all we were faced with. But really frustrating, really challenging. And this is for somebody that knows this space, but it's still, especially when you're going through it with a family member, very, very challenging, very hard.
There's a whole new industry that's kind of launched here in the last 10 years. They're called placement professionals. And these are, I put them into the realm of real estate agents that help to find you a home. Well, these women and men, they know all the communities, and they know the ones that have open beds and the ones that can handle this and handle that, and they know the price ranges. So these people, these placement professionals, they know the industry, and they know, once they met mom and what's wrong with her, they can help recommend and find the right place. So you don't have to call 50 places to find out if there's even an open bed or get on a waiting list. Mm-hmm. So the industry's, servicing, finding services a lot more. There's all kinds of resources on the internet, of course. One wonderful company that's out of Portland called Retirement Connection. It's just retirementconnection.com. You can find all kinds of communities in any Oregon or Washington area. You can find all the adult family homes, all the assisted living communities. So it's all in one resource. So it's pretty cool. One other thing about services is that people are confused about sometimes is the VA. I'll hear somebody say, my husband's a VA, he's a vet, so he's got long-term care. No, he doesn't. To get VA benefits, you have to have a disability ranking that's at the 1 or a 2, and every veteran home is so full that there's just no beds. And the home care piece of it is almost non-existent. There is what's called the aid and attendance benefit. That's kind of like applying for Medicaid, but it's not, you don't have to be completely broke, but you have to be pretty low in wealth before the VA aid and attendance benefit pays out. And that's like $1,800 a month, which again, is not much.
So what you're saying is that there is a veteran's benefit available for long-term care, but you have to have a disability that's going to qualify you for that level of care. And then you mentioned that the facilities are pretty full. So it's a matter of being able to, you might be on a wait list to get into a facility depending on the level of disability that you have and the level of coverage that you have.
Yeah, I mean, that wait list could be 4 years. And so, what are you going to do for the first 4 years? You're going to spend all your money if you don't have insurance. or your wife's going to take care of you day in and day out, and while you're waiting for the VA bed, and it might not, if you live in Tacoma, there's one there, but you might have to go to the one in Walla Walla. The first open bed is what you want, so now you move dad all the way to Walla Walla because there's an open bed there, or Spokane or somewhere.
Continuing care retirement communities I've seen a couple of people actually go this path where they've said, hey, we can move in, we're young, we're healthy, they've got all these activities, they take care of meals, they've got pickleball courts, David, for you and I, maybe that's where we'll end up, but so they've got this really great lifestyle. You move in, continuing care retirement community, and then the idea is you pay a big chunk of money to get into those places, but then the idea is that they have all the levels of care so that you can age in place. So if you need assisted living, you can stay there and have assisted living. If you need nursing home, they have the nursing home facility. Do you have any experience with continuing care retirement communities, and how would you talk about that in the context of planning for long-term care?
Well, that's where I'm going to be, is in one of those. That's where my parents are in. I call my parents' community a stationary cruise ship, because it really does have pickleball. It's got an indoor driving range. It's got every amenity you'd ever want to know. Now, it was in Spokane. It is in Spokane, and they only paid $311,000 to move in there. And it does have all the continuums, but it has every amenity you'd ever want. But here in the Seattle area, most of those continuum communities have a waiting list of multi-year, and they're over $1 million in, most people end up selling their homes to move in and get on the waiting list, and then they sell their home and use that money for the down payment. That down payment money, a percentage of it comes back depending on how you set up your contract. With my parents, 80% of that money comes back to us after they both pass.
Regardless of long-term care. So some of the $311,000, 80% of it could come back to you, or is that a guarantee that it's going to come back to you?
It's a guarantee so the only reason it wouldn't be a guarantee is if they happen to run out of money and they never get kicked out, and they would end up on that refund. They would spend some of that 311 if they didn't have the wealth to keep them from getting into that. But obviously they have long-term care insurance and they're doing pretty well. So they'll never, that money will come back to us.
Yeah. I saw there's a place in Gig Harbor, 30 minutes from my office, where I know they have a pretty robust offering there. And I think they, like you said, they've got a long wait list now. And when they were first building it years ago, I remember I went to a presentation just to learn about how it worked. But today they're at capacity, the last I heard. And so it's interesting. It's interesting the different types of communities that are popping up in order to try to help people with this longevity issue. I mean, the fact is that people are living a really long time, and sometimes that means you're going to need some assistance at the end of your life. In the state of Washington, we had this new law passed a while back, and you had mentioned to me that you had heard something similar was happening in New York now, where there's this mandated coverage that you're going to have to pay for through payroll. Do you want to take a minute and just talk to our listeners about this new Washington CARES payroll deduction and what that's going to cover and how it works?
Yeah, so in Washington, it's called the Washington CARES Fund, and it's a mandated payroll deduction that actually starts with somebody's first paycheck on July 1st of this year. So in 2 months, anybody that's a W-2 employee that didn't buy long-term care insurance before November 1st of 2021, so it was 18 months ago or so, that you had to buy a policy and then get the opt-out so that your employer won't take the money out of your paycheck. So now the Governor Inslee delayed that tax deduction. They didn't change anything with the law except just a few things within it, but the tax deduction starts July 1st. It pays for a very small long-term care program. It's $100 a day for 365 days. So it's a $36,000 insurance policy that anybody over the age of 18 will pay into. And if somebody's 63 and they only have 2 more years to work, they're only going to get 20% of the benefit, because every year you pay into it, you get a 10% vesting. So after 10 years of paying in, then you're vested. But if you leave the state, you forfeit it. But 14 other states are currently working on their own version of, copycat Washington, because we're going to get in Washington $1 billion of tax revenue a year from that tax. And that's a lot of money in an area where Medicare and Medicaid are, getting overused. It's just putting a Band-Aid on Medicaid is what it's doing.
I remember a couple of years ago when people were considering this, it was the high income earners that were saying, boy, I've got to get a policy because this tax was going to be really significant from a payroll standpoint. If you're a high income, you had high wages. And those were the people that were really looking at having some type of coverage in place so that they could avoid it, avoid this new tax. And then you had to opt out of this new tax. If you had the policy in place, like you said, before November, you could actually opt out and not have to pay the tax, which is interesting. And it's kind of neat for people to have the insurance in place.
And if you were self-employed or have your own business, you weren't even obligated to pay the tax. And
federal employees, I think federal employees didn't have to, they weren't going to be impacted by it either.
Correct.
Yeah.
But the tax is, it's basically 6 cents for every $100 you make. So if somebody makes $100,000 a year, it's a $50 a month tax. Not a big deal. If you make $1 million a year, it's $5,000.
Any idea what's going on with the federal long-term care insurance? At one time, federal employees had a really good policy that they could consider.
That was John Hancock. It was a group plan from John Hancock, and it's still, I think it might, well, it's not. When John Hancock got out of the long-term care industry, they were stuck by contract to keep selling the federal plan for a number of years, but I think that's all over now.
Yeah, that's what I was wondering. It seems to me that somebody looked into it recently and they didn't have that option available to them.
Probably been 3 or 4 years since I've heard of that program.
Okay.
So it must have faded out.
Okay. Well, this has really been good, David. Is there anything else that you would want to make sure our listeners are thinking about or considering as they're trying to wade through this confusing topic of long-term care and they're doing their retirement planning?
I would just encourage anybody, whether it's a single person with no children to like my parents had 6 children, is have the conversation with your spouse and with your family as to, if something happens to us, what do you want to have happen? Because the kids will always say, not always, but the kids will say, oh, mom, we'll take care of you. Well, of course they will. But do you really want them taking care of you as opposed to just helping you out? Mm-hmm. And so that a lot of times that conversation never happens, to where, mom will never put you in the home. Mm-hmm. Well, I'll give you a quick statistic that people were surveyed, and 95% of the people surveyed wanted to stay in their homes and live their life out in their homes. That's great. 5% didn't, and that's me going to the CCRC later, because that's where I'm going. But the of the 95% that wanted to live in their home, only 30% got that goal of staying in their home. So basically 65% of the respondents of this survey had to go somewhere, to an adult family home, to assisted living, to a nursing home, because it just gets to be, if it's a 24-hour thing, home care is $12,000 a month easy to $15,000 a month easy in the Seattle area if you have 24-hour home care. If you're in a community, you could be 8 to 10, so it's a little less, but now you've got a whole community taking care of you all day long.
You mentioned that your parents had the CCRC. They went down the CCRC path. Did they also have insurance?
Oh, yeah. It's paying about 80% of their bill.
Wow. Okay. One of the things that I did with these family members is when they were still healthy, we had a conversation about, hey, how do we know if the time comes where you need long-term care? And like everybody, we, as adult kids, we wanted to take care of the family, but we just said, I asked the question, how do we know when the time comes where it would be okay? And they told us, they shared with us, hey, if we get to the point where we can't do this or we need help with this, it's time for us to get into a care facility. And I'll tell you, that's really a hard thing to do as a family member, is to help transition people that you love into a facility where you're concerned that the level of care may not, you just want to know that those people are going to be taken care of. And so, but we had that conversation. So when those events occurred where they we hit that criteria that they told me this is when we need to go into a facility, it made it easier for me to say, okay, here's the next step in the process. This is when they said that they would, want us to help get them into a care facility because we had that conversation ahead of time. But you're right. Most people, there's a guilt that is there because you want the best for them. They want to stay home as long as possible. But you just get to this breaking point where you're like, boy, we can't provide the level of care that the people need. And so then you start exploring the options that are available to you.
Taking the keys away, from mom or dad is that's usually a kind of a first step. But the other part, and the point you were just kind of making there, Jason, is that if somebody's planning ahead to move into a community like the stationary cruise ship I'm talking about, you got to be months and months ahead of that. You can't just, have the stroke or have the, break your back or have serious cancer and just move into assisted living the next day because the places are full. And this was the interesting thing that happened with my parents' community. 600 units in this place. It's huge. It's 2 towers. It's a big place.
Wow.
Well, the average census of the ages of the people that used to move in there 10 years ago was in the late 80s. That's how old you were when you moved into that community, was the late 80s. Now, because of the lifestyle, the stationary cruise ship country club lifestyle, people are moving in their early 80s. And so what happens is, I move into apartment 407 and I live there now for 5 years or 8 years. Well, for the first 5 years, I'm independent. Just taking advantage of the amenities and the country club atmosphere. The last 2 or 3 years, maybe I need care and I move to a different area. But you have to move into the independent wing first. You don't just get to move right into assisted living. In most cases, you have to continuum from independent to need. And so the independent rooms are full. And the only way a room opens up is somebody dies, somebody just decides to move to Texas with their daughter, or they just run out of money. Not in a CCRC so much, but that's how open beds happen in the communities is, there's only 3 ways. Somebody moves out for different location. Mostly it's because they die or they run out of money and they get kicked out. So you have to be well ahead of where you think you want to live. And it's kind of fun. I joke with my clients, go take a tour of a couple places in your community and just get the free lunch. Let them give you the tour. And you might just really connect with this place, or you might go, oh my gosh, I don't want to live in a place like this. I will stay in my home. So knowing where you want to be, you got to be ahead of it now because all these marketing directors that I know in these assisted living communities, when they're 95% full, that's full.
Yeah, I've even seen people in their late 60s, early 70s moving into the CCRCs.
Yeah.
Because you're right, they really make the lifestyle attractive. If your desire is to be able to travel and do everything you want to do, but not have to cook and clean and mow the lawn and all this other stuff, people like that. They like the sound of it.
The logic of owning a home is you've got homeowners insurance, you've got maintenance, you got to mow the lawn. It's a big deal to own a home and take care of a home. So if all of a sudden you don't have mortgage insurance, real estate taxes, and getting a new roof on your house every 20 years, all that money you spend living in your home just gets converted to your monthly fee in your community. So you don't necessarily spend more money, you just spend money differently.
Yeah. Well, you've been doing this a long time, David, and we appreciate your expertise. And just as though, there's fewer insurance companies out there, there's fewer and fewer people that specialize in this type of insurance. So we appreciate having you as a resource that we can tell people about, and appreciate the work you're doing. Thank you for taking time to just educate our listeners. Anything else you want to leave our listeners with before we finish up today?
Well, you just kind of said it. There's not a whole lot of people. You won't find very many insurance people that even want to touch long-term care. It's always been that case. So I've had this little niche because I had some family experiences. Now I currently have more family experiences of watching the dynamics happen. And, where I really feel good about my career is now with this over 100 people on claim. When I watch the claims process play out and how it helps tremendously on lots of levels, it's pretty satisfying.
Yeah, that's great.
So
that's really good. Well, thank you. Thanks for being a guest on Sound Retirement Radio.
All right. Well, Jason, I appreciate you letting me be on today.
All right. Thanks. Take care, David.
All right. Be good.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent, fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.